Something just broke. Something unprecedented is happening in the silver market, and it's not showing up where most people are looking. On paper, silver is trading around $67 an ounce, but in the real world, the world of coins, bars, vaults, and delivery, silver is no longer trading at $67. It's trading much higher. Or more accurately, it's not trading at all because physical silver is disappearing. Dealers are sold out, premiums are exploding, local coin shops are freezing. And the market that most investors rely on, the spot price, is rapidly losing its connection to reality. This is not a short squeeze. This is not hype. This is not a temporary disruption. This is a structural breakdown that has been building for years and has now reached a breaking point. Part 1. December 20th, 2025, the day the physical market froze. Let's start with what actually happened. On December 20th, 2025, silver's spot price surged to $69.40. That alone would have been notable. But what followed was far more important. Major online bullion dealers, names everyone recognizes, began showing the same message. Out of stock. JM Bullion, APMEX, SD Bullion. Popular products vanished. American Silver Eagles, gone. Generic rounds, gone. 10 Oz bars, gone. What little inventory remained came with premiums so high they shocked even seasoned buyers. $10 premiums, $12 premiums, $15 premiums. That means the real price of silver, the price you actually had to pay, was closer to $77 or $78 per ounce. And even then, availability was limited. Meanwhile, local coin shops did something even more telling. They stopped quoting prices. Some refused to sell, others refused to buy. Not because demand disappeared, but because they had no way to replace inventory. When dealers stop transacting entirely, that is not a bull market. That is a market failure. Part 2. Why dealers are panicking. To understand the panic, you have to understand how bullion dealers operate. Dealers don't speculate on price direction. They operate on thin margins. They buy from wholesalers. They sell to customers. They immediately restock. But that system only works if replacement inventory is available at predictable prices. That assumption just broke. Dealers who sold silver earlier in the week at $58, $60, even $63 now face a nightmare. When they try to restock, wholesalers are quoting prices far above spot. In some cases, wholesale prices are moving faster than the futures market. If a dealer sells today and tries to restock tomorrow, they risk locking in a loss large enough to wipe out months or years of profits. So what do rational dealers do? They pull inventory offline. They halt sales. They wait. Not because they don't believe in silver, but because selling now could mean bankruptcy later. That is what panic looks like in a physical commodity market. Part 3. This is not demand hype. It's a structural deficit. Here's where most people get this wrong. They assume this is caused by retail investors rushing to buy coins. That's not what's driving this. Retail demand matters, but it is not the root cause. The real problem is far deeper. Silver is in a structural multi-year supply deficit, and that deficit is no longer manageable. Part 4. Demand has become inelastic. Silver demand today is fundamentally different from the past. This is not jewelry demand. This is not decorative demand. This is not discretionary demand. This is industrial demand. And industrial demand does not respond to price the way luxury goods do. Solar power. Solar panels are now the single largest source of silver demand. Since 2015, silver use in solar has more than tripled. In 2025 alone, solar consumed over 210 million ounces of silver. And here's the critical point. If silver doubles in price, solar installations don't stop. Governments mandate renewable targets. Utilities lock in long-term contracts. Manufacturers must deliver. They compress margins. They raise prices. They absorb costs. But they do not stop using silver. Electric vehicles, EVs, use 2 to 3 times more silver than internal combustion vehicles. Not just in the battery, but in power electronics, sensors, charging infrastructure, and grid connections. By 2025, EV-related silver demand reached roughly 90 million ounces per year. And that number is still growing. AI and data centers. This is the most underreported demand driver. AI requires massive physical infrastructure. Servers, power management, thermal systems, high-frequency electronics. Silver is essential in all of it. This demand didn't exist at scale a decade ago. Now it's accelerating, and none of it is optional. Part 5, the numbers don't lie. Let's put real numbers on this. Total 2025 silver demand. Approximately 1.2 billion ounces. Total 2025 silver supply, mining plus recycling are in sucker. Watch 1.01 billion ounces. That leaves a 190 million ounce deficit. That deficit must be filled by one place and one place only. Above ground inventories. And those inventories are being drained fast. Part 6. Inventories are being destroyed. Warehouse inventories are the shock absorbers of the silver market. They smooth deficits. They buffer demand spikes. They provide delivery capacity. Those buffers are gone. COMEX registered silver, the metal actually available for delivery, has been collapsing. In the first 4 days of December 2025 alone, registered inventories dropped 60%. That is not normal. That is not seasonal. That is not noise. At current levels, COMEX registered silver covers weeks, not months, of global demand. Meanwhile, the LBMA shows similar drawdowns. And China? China is not exporting silver. China is importing, stockpiling, consuming. Once silver enters Chinese industrial supply chains, it does not come back. Part 7. Paper price versus physical reality. Here's where the system fractures. The spot price of silver is set in the futures market, a market dominated by paper contracts, contracts that promise silver but rarely deliver it. For decades, this worked because physical supply was abundant. That is no longer true. Now we have two prices: the paper price, the physical price. And they are no longer the same thing. When premiums explode and availability vanishes, the paper price loses authority. Eventually, one of two things must happen. Either the paper price rises violently to meet physical reality, or the paper market fails. Cash settlement replaces delivery. Both outcomes are bullish for physical silver. Neither is orderly. Part 8. This is not a temporary squeeze. This is not GameStop. This is not a meme. This is not a positioning hiccup. This is a multi-year structural imbalance finally asserting itself. Supply cannot respond quickly. New silver mines take 10, 15 years. Billions in capital. Stable jurisdictions. Most silver is mined as a byproduct of other metals. That means even higher prices don't immediately increase supply. Demand, meanwhile, is locked in. That is the definition of a hard commodity shortage. Part 9. What this means for physical buyers. So the question becomes unavoidable. What should investors actually do in a market like this? The first step is understanding that there are trade-offs, and ignoring them is how people get hurt. Physical silver is no longer a simple commodity purchase. It is a strategic decision. Physical silver, ownership versus price. For long-term holders, owning physical silver, even at elevated premiums, can still make sense. Why? Because when you buy physical silver today, you're not just buying metal, you are buying scarcity. You're removing yourself from the paper pricing system, where silver exists mostly as contracts, IOUs, and derivatives. You are eliminating counterparty risk. No broker, no custodian, no clearinghouse standing between you and the asset. And in periods of market stress, that distinction becomes everything. When inventories are shrinking and delivery is uncertain, ownership matters more than entry price. That said, this is not a risk-free decision. High premiums change the math. If the spot price pulls back, even temporarily, premiums may not compress right away. In past shortages, premiums have stayed elevated long after spot corrected. That creates a danger for short-term traders. If your plan is to flip physical silver in weeks or months, elevated premiums can work against you. This is not a momentum trade. This is not a scalp. This is not a speculation on tomorrow's price. Buying physical silver in this environment is a positioning decision, not a timing decision. It is about where you want to stand when the system is under stress, not about catching the next 5 move. Part 10. Silver mining stocks. The leverage play. Expanded. For investors who want exposure without paying large premiums, silver mining stocks offer a very different path. Mining stocks provide leverage to the price of silver. Most silver miners have relatively fixed operating costs. They pay for labor, energy, equipment, royalties. Those costs do not rise dollar for dollar with silver prices. So when silver rises, the impact on miners is asymmetric. Revenues increase rapidly, margins expand dramatically, cash flow accelerates. This is why miners often outperform the metal itself during sustained bull markets. Companies frequently discussed in this context include Pan American Silver, PAS, large-scale producer with geographic diversification, First Majestic, AG, high silver exposure and strong leverage to price moves, Hecla Mining, HL, long-life assets and exposure to U.S. production. These companies can benefit disproportionately if silver prices remain elevated or continue higher. But leverage cuts both ways. Mining stocks carry risks that physical silver does not. Jurisdictional risk. Governments can change taxes, royalties, or regulations. Operational risk. Mines flood, equipment fails, grades disappoint. Equity market risk. Even profitable miners can fall during broader market sell-offs. This is why mining stocks are not a substitute for physical silver. They are a financial expression of the same thesis. They amplify upside, but they also amplify volatility. Part 11. Price targets. Context, not prediction, expanded. Price targets get attention, but they are often misunderstood. They are not promises. They are not forecasts. They are reference points. Short-term, silver testing, $70 is entirely plausible given current momentum and supply stress. Medium-term prices in the $80 to $100 range align with simple deficit math once inventory buffers are exhausted. And long-term? Silver's inflation-adjusted high from 1980 sits around $127 per ounce. Whether silver ever reaches that level depends on multiple factors: monetary policy and currency debasement, the pace of industrial expansion, the exhaustion or replenishment of above-ground inventories. But the most important insight is not the upside target, it's the downside constraint. When the world is structurally short a commodity, when demand exceeds supply year after year, severe crashes become much less likely. Volatility remains, corrections still happen. But the probability of a prolonged collapse diminishes when inventories are gone and demand is locked in. Part 12. Strategy, patience, not panic. This is not a market that rewards emotional decisions. Volatility will be extreme. Price swings will be violent. Headlines will exaggerate both fear and euphoria. Pullbacks to $65 or even $60 are entirely possible. That does not invalidate the thesis. What matters is why silver is rising. This move is not being driven by excessive leverage or speculative mania. It is being driven by physical scarcity, and scarcity behaves differently than speculation. Those who chase price at emotional highs often regret it. Those who wait for dislocations, pullbacks, or periods of uncertainty often find better entries. Patience is not passive. It is strategic. Final warning: this is a historic moment. Silver is a small market. That is precisely what makes this situation so dangerous and so powerful. In large markets, shortages can be absorbed. Inventories shift, producers respond. In small markets, shortages explode, and all the conditions for that kind of explosion are now in place. Persistent structural deficits, drained warehouse inventories, inelastic industrial demand. Dealer panic and withdrawal. A widening gap between paper and physical pricing. This is what the early stages of a supply chain failure look like. Not chaos, not headlines, but quiet breakdowns in availability. Closing: the silver squeeze is not coming. The silver squeeze is not something to wait for. It's already here, not in futures charts, not in ETF inflows, not in mainstream news, but in the physical market, where silver is sold out, where premiums are screaming, where dealers have stepped aside, where supply has vanished. The question is no longer whether silver is undervalued. The question is how the system resolves a shortage it can no longer hide. Because when physical reality takes control, paper promises don't stand a chance.